Hello and welcome to the SuperReturn webinar. I'm Michaela Virtue, Creative Director for SuperReturn International Berlin. Today we'll be discussing Brexit and to what extent it's a game changer for private equity. We're joined by David Smith, Managing Director and Co-Head of Co-Investment at Capital Dynamics, who will be moderating the discussion. David is also Chair of the firm's Clean Energy and Infrastructure Investment Committee in respect of certain existing investment mandates. He has 29 years of experience in private equity and infrastructure financing. Prior to joining Capital Dynamics, David worked with GE Capital in the UK and US, as well as with GE's European private equity businesses. Earlier in his career, he served as an advisor to AXA Private Equity and established the European business of First Reserve Corporation, prior to which he was with BP Ventures' solo photovoltaics business. David serves on the board of directors of the Major Projects Association and is a member of the Institution of Engineering and Technology. Thank you very much for joining us, David. I will hand it over to you to introduce your panel.
Michaela, it's a pleasure to be here, and welcome to all of those who have dialed in and are participating here. I understand we have several hundred registrants, and I hope you find this interesting. I'm very pleased, in fact delighted, to introduce our panel today. We've got two senior people from different sides of the private equity industry. One, if you like, more from the equity side and one from the debt side. I hope that provides balance in our discussion today. And let me start with the equity. Delighted to introduce Karim Khairallah of Oaktree Capital. Karim is a managing director with that firm. He's been in the alternative investment industry, private equity industry for many, many years, involved with organizations such as Solidus Partners, General Atlantic, JP Morgan and others, and also a very active board member in terms of his portfolio company participations, some of which you'll know very well. So delighted to have Karim with us. As we move ahead in the running order here, also delighted to introduce Nigel Walder, also a managing director, but this time Bain Capital. Nigel has a very long and experience in the debt side of our business, in the leverage finance piece of the equation in particular. Joined Bain Capital in 2015, but extensive leverage finance experience with JP Morgan, with responsibility for underwriting and distributing high yield debt and leverage loans, principally for financial sponsors, but also others. I hope that provides the balance we would like to see in this webinar. Now, moving ahead, what a question. What is the current situation with Brexit? One I think, interesting and probably difficult and perhaps early question, given where we are in the Brexit journey. But what I think we'd like to do today with you all is to break that question down and answer it with three sub-answers, if you like, focusing on different perspectives of Brexit and how it affects each of us here on the delivery side of this webinar, and I hope very much also you all who are listening in and are perhaps watching on screen as well. So the three categories of the answer we're likely to focus on here are: one, how did it affect existing portfolios of organizations like Nigel's and like Karim's? I think it's important to understand how that happens and how investors in funds with existing investments are likely to see their portfolios evolve. Next, and in chronological order, I think the discussion of the market environment and the impact on future investments is important. And again, what's happening and what has happened in the last 2 or 3 weeks, I think will change the way in which some of us see private equity, how we behave and how we make future investments and how we select investments, particularly for those of you who are limited partners on the call today, on the webinar today. And last but by no means least, the whole issue of exit from the EU for those of us who are involved with things like AIFMD and some of the passporting requirements that impinge on our business. I think it's important for us to understand, particularly those of us in the UK, how we might be able to continue raising funds and providing the services we currently provide to investors outside the UK through an evolution perhaps of the passporting relationships and passporting arrangements we currently enjoy. That really is all I wanted to say in terms of introductory remarks. I'd like now really to page through the materials we have ready for you and focus on the first sort of sub-answer that I mentioned earlier, that relating to the impact on existing portfolios. But before I do, can I just remind you all, particularly those of you who are logged in on screen, we want to make this as interactive as possible. It's a little bit more difficult to do that in a webinar form than perhaps the Super Return conference form that many of us are used to. But you should find on your screens towards the bottom of the slide area a box which will enable you to put questions to us all as we deliver the material we have for you. You'll find that box, I think it's a red box, an Ask Questions button, and I'd encourage you all very much to use that so we can respond as best we can in the last 15 minutes or so of the webinar. I hope you find that feature helpful, and again, I'd encourage you to use it. So, as we go into the first sub-answer, I'd really like to think about how we will look at Brexit in the context of existing portfolios. That's existing portfolios of companies like Karim's, like Nigel's, like my firm, and I'd really just like to introduce a number of themes that I think perhaps would want to think about in terms of those existing portfolios. Things like growth assumptions, things like value investing, things to do with leverage, Nigel's area in particular, and how we see exposures to portfolio investments in the UK and elsewhere. What are we thinking about in terms of those portfolio company diversification parameters, perhaps? And then something that I think has hit us all in different ways, perhaps, the impact of sterling depreciation, perhaps the positives and negatives of that. So having set the scene, as it were, in terms of our existing portfolios, let me sort of put some of those questions to Karim in the first instance. Karim, perhaps would you let us know your views on the impact on existing portfolios and how you think perhaps opportunities can be gained from the situation we find ourselves in?
Thank you, David. I think, first of all, it's probably too early to give any general forecast on what we think will happen. I think we're still within the first month of Brexit. We still haven't seen the full ramifications of what Brexit means, how Brexit is going to be enacted. So it's still very early days, but what Brexit does is create a environment of uncertainty and therefore volatility. And I think as one thinks about portfolio companies and current portfolio companies, then volatility and uncertainty clearly is going to impact companies with more leverage or highly levered companies. It's clearly going to impact companies at the moment that are going to be have some kind of exposure to importing either raw materials or products into the UK. It's going to impact investing or investment thesis that are driven by cyclical upturns, market appreciation, multiple appreciation. So as we look at portfolios, and as I think about how this impacts portfolios, first of all, I think it is way too early to say what will happen, but it is interesting to hypothesize around the impact of volatility on companies and uncertainty around companies, the lack of potential investment that could come into the UK. So you start to then narrow it down to specific sectors who import a lot of European or dollar-denominated product. You focus it around companies that would be impacted by a reduced foreign investment into the country. You look at it also as companies with a lot of leverage. So I think that's how we think through the portfolios. And unless your portfolio company has a strong investment thesis that is not only driven by economic growth, but is also driven by other factors, whether it is structural changes in the market or operational changes you're undertaking to a company, then clearly there will be there is a risk of some kind of impact through Brexit. But again, I don't want to theorize around something where we're not sure of the outcome.
Thanks, Karim. You mentioned a number of times during that delivery leverage or debt financing, a key aspect to all of us who work in buyouts. Nigel, that's very much your area. Could you perhaps pick up that baton and help us a little with what you see the leverage finance markets doing? And firstly, in the context of existing investments, investments perhaps with covenant challenges and so on. What do you think we will be up against in the medium term?
Yeah, look, I think as Karim alluded to, the impact of Brexit, when we know what Brexit means, will mean different things to different companies and different credits, depending on sector, scale, whether they're an importer or an exporter, particularly correlated to GDP, et cetera, et cetera. I'd say more generally, as a capital markets access matter, the major impediment is volatility. And when we see some of the news flow starting to crystallize around what Brexit actually means, it is likely that we'll see market volatility, and that's going to impact the ability of companies to raise financing in the capital markets, to refinance existing capital structures. It's going to impact the ability of portfolio companies to go do mid-cap UK IPOs. And as you've alluded to, I think operationally, as we start to see some of the economic consequences of Brexit play through the system, it's going to impact potentially the economic performance of some of the companies that the sector owns. So I think the challenge is really it's very difficult to at this stage draw any hard and fast conclusions. I think the important takeaway is that there will be moments of volatility in the future, and that's likely to create advantages for those companies that have planned ahead and raised capital when it's available. But I think it's very difficult to sit here today and argue that it's going to dramatically change the funding environment in which we're operating. I think, in fact, if you look at the markets today, the biggest surprise of Brexit has been that whether you look at the debt or the equity markets, they really haven't seemed to have missed a beat.
That's helpful, thank you. Sticking with you, if I may, Nigel, do you think as the debt capital markets start to digest the potential implications of Brexit further, that we'll see a divergence, a stratification, perhaps even a polarization of credits between those that have high sterling exposures, high sterling revenue streams and high exposures to UK customers versus perhaps companies which might be based in Europe, including the United Kingdom, and have a larger proportion of their revenues elsewhere? Do we think we'll see that kind of examination of credits in this market?
Yeah, I think for every credit that's being evaluated right now, the underlying portfolio manager is going to be asking the question, what does Brexit mean for this business? So I do think you're increasingly going to see the market taking a view on that and likely expressing that in terms of price or market access. Until we know kind of how the rules of Brexit shape up, it's tough to know what the answer is going to be for any individual credit, but it's likely to correlate towards sensitivity to economic downturn. I think the other important piece here is that I think recognizing that there is likely to be some volatility in the future, it is entirely possible we see a degree of divergence in terms of the market's willingness or enthusiasm for financing sterling currency exposure. I think you see that already manifested in how some of the single B sterling bonds trade relative to each other, where there's now a meaningful degree of divergence in credit spread for sterling versus euro exposure for broadly comparable companies. And I think as you look at the leveraged loan market, you're likely to see the CLO community express a higher degree of resistance in doing the cross-currency swaps required to place sterling loans. So I think as important as the kind of fundamentals of the credit, there will be a technical overlay that is likely to have an impact kind of as a function of currency.
And just that's helpful, thanks again. And just sticking with leverage for a couple more minutes, and taking it perhaps to a macro level for a moment. We saw the changes in the prices of debt. I'm going to sound like an FT correspondent now and remind everybody that obviously yields move inversely to prices. We're likely therefore to see or have seen lower risk-free rates. That certainly affected the institutional pension fund industry in terms of their liability structures. But if we posit for a moment that we see lower risk-free rates and arguably therefore cheaper money and perhaps a desire on the part of central bankers, including our own, to keep credit flowing, do we think that perhaps modest saving in the underlying risk-free rate will be consumed by margin increase or margin volatility?
Yeah, as we sit here today, and if you look at the major CDS indices out there, which measure that margin, in reality, we're about flat relative to the place we're at prior to Brexit. So on an all-in basis, debt's actually become cheaper post-Brexit, which doesn't sound super logical, but the reality is, as you allude to, there has been a clear statement by the ECB as to their desire to support the credit markets, and I think the reality is for the medium term, I think the belief in the marketplace is that there continues to be an expectation of a broadly benevolent kind of macro overlay in terms of how both the Bank of England and the ECB will support markets whilst this process is ongoing. So again, difficult to draw any definitive conclusions, but I think from the perspectives of any kind of early moves, I think a lot of encouragement should be drawn from how the markets have reacted. From a technical perspective, there remains a lot of cash out there on the sidelines, and just as the reality is the pension community have been impacted negatively in terms of risk-free rates moving lower, that just pushes more cash into the high-yielding, higher-spread products that are most typically used by the private equity industry to raise finance. So I think you can look at the combination of the overlay and the technical and draw a conclusion that for the medium term, you should feel reasonably optimistic about your ability to access capital to continue to function in the private equity industry. I think the credit-specific overlay is really kind of what comes into play in terms of impact. And I think you will see a significant amount of differentiation going on as PMs in the debt community evaluate different credits with different degrees of perceived Brexit risk, be it sectoral, because of scale, or because they're particularly exposed from a currency perspective.
Understood. Thanks. Now moving back to you, Karim. We've heard from Nigel with his DCM hat on. Each of you, to different degrees, you in particular, are now dealing with this from the perspective of your existing portfolio company investments and the stresses that they may face. Perhaps you comment on, perhaps firstly, how prudent do you think organisations like yours have been in using leverage? Have we got situations where we've got tight covenants, and if so, what are we going to do about that? Are we going to see negotiations with banks? Are we going to see follow-on infusions, rounds into existing portfolio companies to stabilise their balance sheets? What's keeping you up at night, Karim, in this respect?
Well, I mean, I look across our portfolio, and I would say, again, too early to predict the impact of Brexit, but where we have UK assets, there's still a lot of room to maneuver, a significant amount of room to maneuver around pound leverage exposure. So I think, for us, we clearly, try and be prudent as investors as much as possible. We clearly try and protect our downside as much as we can. It's very early days for us. But I think if we think more generally, and we look at the impact of Brexit and we focus on the impact of Brexit, we're really talking largely about pound-denominated debt and a lot of pound-denominated assets. And I think there you've seen a real. There's going to be a mixed bag, just like we've had in previous crises around companies that are over-levered and who are going to have their both financial performance, profitability, and cash flows impacted in the short term by Brexit, and therefore will start to have covenant issues. And there are going to be quite a few companies like that. I would say one of the big differences, and it'd be interesting to hear David's view on this, is I think when I compare this to 2000, let's say 8 and 9, debt documentation is far more borrower friendly than it was then. That's number one. And number two is the high yield market has been a much bigger provider of financing than it was leading up to 2008. And the importance of the high yield market, in my view, is you do have very lax covenants. So you have far more ability. You're really talking about a liquidity covenant at the end of the day that would trigger any kind of true negotiations. So I think on the one hand, clearly the uncertainty, the volatility will have impact on certain companies and on their earnings and on their cash flows, and that will then put pressure on covenants. But I also think that there is a slight cushion there around cover-light models and around high yield financing.
Okay. You asked for a comment, I think, from me there, Karim. So let me just respond to that before moving ahead in the discussion to talk about future investment behaviour. Having listened to you just for the last 10 minutes or so, it seems to me as I draw those strands together that there are three things that we should have in our minds. The first, I think, is probably the importance of value investing, buying well. If we bought well in our existing portfolios, I suspect we'll be reasonably well covered. If we bought well and made less than heroic growth assumptions in terms of revenues and EBITDA in particular, I think the same applies. And then picking up, I think, the important leverage point and the step back in time to 2008, 2009, leverage prudence and sort of benign capital structures, I would suggest are important to the stability of existing portfolios. Before I march on to the next section, i.e. how will Brexit affect the market environment and affect future investments, can I just remind you all to use those questions features on your screens. I think it's the red button with a bit of blue in it. I can see on my screen that we're having questions coming in, which is great. I'd encourage you to continue to make us work for a living here. So moving ahead, on to the next section, really the market environment and the impact on future investments. I'd like to spend 10 or 15 minutes on this before we get to some of the drier stuff, I'm afraid, at the end of the regulatory and legal aspects. I hope I haven't insulted too many lawyers on the call. I'm sure if I have, you'll be in touch with me. Sort of dividing the market environment and impact on future investments up still further, if you like, sort of slicing and dicing that subject area. I think the first issue to me would be, what is the horizon of uncertainty? You know, are we talking about a year? Are we talking about a decade? Those of us who keep an eye on the press, certainly in this country, in the UK, have seen everything from months to a former cabinet secretary comparing the situation to the exit of Greenland from a similar union some years ago, and arguing that that was very simple. Our interaction with the EU is much more complex and will take a good long time to unravel. Whilst we think about that horizon of uncertainty, that word uncertainty gives us all the jitters. It makes us cautious. What does that mean? What does it mean for the equity markets? We've just spent some time focusing on the debt capital markets with Nigel. What does it mean in terms of equity market volatility, and in particular for those of us who look to the IPO market for exits? What does it mean for the likelihood of pulling off those exits? Are we going to see illiquidity? Are we going to have a credit crunch ultimately, or a credit scarcity for future investments, particularly those that are polarized in some way from a regional perspective? I think that leads us into diversification, both by country and by sector. We've seen certain troubled sectors suffer in the public equity markets, e.g. financial services, construction and travel, perhaps not surprising. And I think what does all that mean for future investment behavior, future capital structure, and last but by no means least, what I've sort of teed up here is currency-driven competitiveness and opportunity. And let me actually start with that one, because when I put these notes together for this webinar, that seemed to us as Capital Dynamics an important feature of what was going on. And then lo and behold, we saw the announcement that SoftBank was taking a run at ARM, I think in part due to the fact that they've seen themselves getting something that looks 10 to 15% cheaper than it was 2 or 3 weeks ago. So let me hand that baton to you to start with, Karim. How are you looking at changes, and where do you think the opportunities are in an environment like this?
Well, I think on the one side, David, as you mentioned, we don't know how long a period of uncertainty we're going to have, and I think that's going to drive decision making around investments. Clearly, we know that the uncertainty creates volatility and therefore creates opportunities, but it doesn't create necessarily the right confidence in knowing what the outcome would be. And I think that is the big issue for an investor today, is how do you take advantage of the uncertainty with the knowledge that you have limited view of the outcome. And that's, I think, what we grapple with as investors, is trying to make sure that we have the best possible analysis of the risk that we're undertaking in this uncertain time. So I think there are a couple of things on our side that we find interesting. Number one is the spread between illiquid and liquid assets, and that illiquidity and liquidity can be defined by either quality of asset, size of asset, or scale of asset. And whereas we've seen that spread potentially narrow in the UK over the last couple of years, we're starting to Brexit will potentially lead to that spread widening again, and I think that means that there could be some potentially interesting investment opportunity in illiquid assets. I think what we're going to see, one of these scenarios you could see is, and the ARM transaction is potentially a good example of that, is this flight to quality. and that, in this sense here, you had an opportunity to buy one of the leading technology companies in the world at what was maybe a 10 to 20% discount from what it would have been a month ago, given currency movements. So I think there's definitely a combination of flight to quality. So if people buy in the UK, they'll be buying quality assets today, which might at least sustain and potentially in some cases bring yields down or bring multiples up in some perverse scenarios. Two is currency would also drive that as well, especially for US dollar-based investors. There's clearly a currency play here. So as we look at it, we think that the universe of high-quality opportunities will still be there and will still be attractive and might actually attract a different type of investor than we would have seen 6 months ago. But where we see the most opportunities is in some of the smaller, more illiquid assets that are going to be impacted by lack of foreign capital looking to buy into them, potentially lack of financing. As Nigel was talking about before, one of the key things that portfolio managers are going to do now is pick very carefully what kind of pound exposure they want to take. And more illiquid, small and medium-sized lending opportunities might be less attractive than the more liquid, larger opportunities. So I think that's one of the areas where we see some real opportunities is the potential widening of spreads between liquid and illiquid assets and the ability to buy illiquid assets and try and create a liquid scenario over time through some of the things you talked about, David, around operational involvement, buying with a thesis that isn't just based on cyclical upturn, buying without too much leverage and giving yourself room to maneuver and really create some quality assets.
Thanks very much. Nigel, pretty much the same question to you. I know it's always a bit more difficult coming second when Karim has covered many of the points, but anything you'd add to that remark or that set of remarks?
Yeah, look. I think the horizon of uncertainty, as you frame it, will be long. But I'm not clear that necessarily means that there won't be interesting opportunities to get cash out the door and make good investments. 1 month on, we've got a functioning capital market, both in the equity and the financing markets, which is an encouraging sign. I think the reality is the market broadly have been used to uncertainty for a reasonable period of time now. And actually, if you look at the nearest potential catalyst to volatility, it's not anything to do with Brexit. It's most likely the US elections and the Italian referendum later on this year, both of which are going to be potential touch points for the market that could cause dislocation. And I think the emphasis from our side as we're looking at opportunities is just going into these opportunities with our eyes open around the risks, and I think Brexit's just another one of those risks. I think there are likely to be opportunities that are pretty interesting. Obviously, there are going to be troubled sectors in the UK as we get into the teeth of this. I think also, frankly, one of the opportunities, if you look at the last 6 or 9 months, one of the challenges the private equity community have had is that it's been difficult to sustain transaction volumes when corporate M&A has been so active and when the IPO markets have presented an attractive exit opportunity. And I think one of the things that will be a side effect of this volatility is that there's likely to be a check from some of the corporates on the M&A activity, and it's likely that the bar will be higher for successful IPOs. And as Karim alluded to, some of these smaller, more illiquid assets, I think we'll find it tougher to get access to the public equity markets, which will more naturally push them towards the arms of private equity. So I think there are some reasons to be optimistic and to be of the view that there will be interesting opportunities. The important thing, I think, for the community is just being thoughtful about the risks that we're facing and the environment in which we're buying these businesses. and ensuring that we price those risks appropriately.
Thanks for that. I'd like to pick up on something relating to liquidity and leave that question with you, if I may. We've just discussed the difference in liquidity between the public markets and the private markets. Historically, the private markets have provided in private equity something like a 3 to 5% liquidity or illiquidity, to be precise, premium above public market returns on a PME or PME plus basis. I think most of us on this call are familiar with those terms. I wonder when we have that divergence in liquidity between those two markets, and perhaps an enhancement in that, are we going to see a situation where bid-offer spreads in private market transactions increase to a point where it's difficult to get transactions to clear, to get transactions to trade? And if so, do we think we'll see the usual structures to get us around those issues, ratchets, deferred consideration elements, and so on? Are we going to see an effect on the structuring of transactions? I'll leave that with you, if I may, Nigel.
Yeah, of course. It's a great question. Look, I think the reality is, and you've seen it in, of course, the last few weeks, there's been an increase in the number of pulled auctions and failed transactions. The markets tend to take a little period of time to adjust to a new norm, and you may very well start to see some of these more structured solutions come through as a way of bridging towards that, and facilitating transactions being done. The one kind of note of caution I would have is that it's not really like we're in the world of the new norm yet. There hasn't been a dramatic impact on valuations, at least in screen valuations, to which people have had to adjust. So it's difficult to say definitively. I think the reality is that if there were to be a major adjustment, there will likely be a period where the more structured solutions make an appearance. But I think the nature of the industry and the way in which everybody's funds are set up is such that at a point in time, there will be a point where it makes sense for people to transact. And that it's difficult to know until we know the nature of the Brexit process, kind of how dramatic the impact will be, and therefore how long that lag could take to pick up. But I tend to be of the view that over time, a degree of volatility in public markets has to be a catalyst to increase volume in the private markets. Okay, and just sort of sticking with you before we move on to the next section, I'm interested to take you bridging really from the comments you made earlier in respect of leverage and existing portfolios to the kind of debt structures we might see in a post-referendum world. Are we going to see any fundamental differences, Nigel, either in terms of the structure of those credit facilities on the one hand, or in the availability, or put differently, the scarcity of debt on the other hand from the various participants in the leverage loan market, be it high yield or other forms? Yeah, look, right now I think the conclusion would be the macro overlay and the strength of the technicals are so strong that that's really dominating the answer, and that whilst people might seek to price different credits in a different way than they did prior to June 24th, the probability is that markets will remain open and functioning in broadly similar manners for the right credit. We've seen a couple of dividend recaps now be announced post-Brexit. We're continuing to see very aggressive staples being put up on assets that are coming to market that are of high quality and not overly exposed to what I call Brexit risk. So I think for the most part, if you look on a pan-European basis, you're going to see a continuation of what we've seen over the last 2 years. I think the area where I suspect we'll see more caution and more impact is around institutional financing of sterling assets. The depth of the market for institutional term loan B in pounds and the price point at which we'll be able to raise high yield bonds in sterling. And you see that manifested in the secondary levels today. I think that will be a theme that likely continues until we see some of the uncertainty put behind us.
That's encouraging news. My fear at one point a couple of weeks ago was, would it be credit crunch or credit crimp? I think you're saying that my fears in large part are probably misplaced, which I suspect is a good thing for most of us on this webinar. Thank you for that, Nigel. Let me now move ahead to the final section before Q&A, and as I do that, I'd remind you all again to please use that Ask Questions button. I can see you're hearing me because they're rolling in on my screen, so I'm hopeful that we leave enough time at the end to respond to some of them. Some of you I see have got a little ahead of the agenda here, which is great, looking at the impact of AIFMD and so on. So what I'd like to do now is just to hit that last area, that hallowed territory, if you like, for the lawyers on the call, the legal and regulatory considerations. And let me just sort of tee that up in three ways, really, using that sort of horizon of uncertainty phrase that I used a moment ago. How far away is that regulatory horizon? What are we going to have to deal with in the interim, and what do we think will be the time at which we see, let me call it AIFMD 2.0 or AIFMD plus or something of that nature. Will people not be willing to wait? Will they just think, I'm going to jump ship? Some of us on this call, whether we're general partners or limited partners, will be aware that a number of firms have multiple European bases. Ours is certainly one of them. So some of us certainly have the opportunity to move from one AIFM in one jurisdiction, the UK, to another, and presumably be able to continue raising money if that were the case. I think there's also the question of people who are active in continental European jurisdictions who will wish to continue to raise money from institutional investors in this country. So a reciprocity argument, if you like. And more generally, how are we all going to keep abreast of these regulatory developments without spending an arm and a leg with regulatory counsel? So can I start that one with you, Karim, if I may?
I mean, I think it's so early to say, what is the impact going to be? I mean, I know that as Oaktree, our key view is, one, is that London is a key centre for us, where we have a lot of our key resources and know-how, and a significant proportion of our European business is based in London. So I don't think that will change dramatically for us, if at all. And clearly, within the private equity world, there are parts of your business that depend on passporting and a lot of that don't. So it'll be interesting to see if there are new directives, which bits it impacts. I'd say the one area where you're seeing the impact of AIFMD is around fundraising across Europe, where there are already some preset rules around local licenses and so on, and that might be expanded further if and when, or let's say when, the UK exits Europe. But we are a long way away from there, and I think our number one priority is to make everyone sitting in our European business confident that we're well situated given what's going on, and that we will react in the right way when things change. But today it's, I think, way too early to predict anything on this. and to make any preemptive changes.
And your views, Nigel? I know coming second is difficult again, but I'm afraid I put you in that box. I'll try and even things up in a moment.
Yeah, I'd say similar view. Very early to draw any hard and fast conclusions. I'd say the reality is, even if the passport goes away, I think both the AIFMD and MiFID II legislation contemplates some degree of free access to the extent there's regulatory equivalence, which I think potentially opens the door to a happy in-between spot. But I think from the perspective of planning out kind of what's the right response, it's very tough to do that until we see what the landing place is going to be.
So are you, as an organisation, and I'll ask the same question of Karim in a second, are you thinking that remaining flexible in terms of your organisational structure as a fund manager is the most important thing right now?
We are a pan-European entity with offices across Europe, all of which are pretty active. So day to day, I think we've got good redundancy kind of built into how we operate that wouldn't dramatically change things for us. And
same question to you, Karim.
I mean, I think it's a similar view. We're a pan-European, a global business that has, every potential and mechanism in place to survive major events and small events. So I think we are, we're well positioned to react to whatever happens, whether it's Brexit or anything else, given the global nature of our business. But it's way too early to predict anything.
Can I flip it round for a moment? Some of the questions that are rolling in on my screen are leading me to do that. We're very apt to be parochial, sitting here in the UK, at least those of us that are sitting here in the UK today, and thinking of it in terms of access to investors in continental Europe for our funds which are based in the UK, perhaps with a UK AIFM or similar. What about the other way around? The manager that's perhaps based, pick a place in Dusseldorf, who sees it as very important to access the local authority pension fund community in this country, for example. What's your view on how that organisation will respond to these challenges? Sorry, to you, Karim, to start with.
I was hoping you wouldn't pick me. It is so hard to predict now. I mean, especially the first thing. I mean, outside regulation, the question for the local authority is appetite to invest outside Europe, outside the UK, sorry, and then appetite to invest in Europe. And across the world, given where currencies are. I mean, I think that's the only thing we can measure today. Is that the pound euro is at 119, the pound dollar is at 130 or so. So that's the only measurable parameter we have today. The rest, I just can't even begin to try and forecast how they would think through that.
And maybe a last question to you, Nigel, before we start to respond to the Q&A which is coming in. And again, I encourage you all again to keep those questions coming in. Will this affect LP appetite for investment in our asset class?
Yeah, look, I think as Karim and I have hopefully laid out over the course of the last few minutes, I think the reality is this will throw up some interesting opportunities in Europe, and I don't think it's going to have a dramatic impact on our ability to both buy and sell companies from an access to capital markets perspective. The reality is the industry is supposed to make its money by generating alpha, and I think there will be opportunities to generate alpha in the markets in which we're going to be operating over the next few years. So I think I remain pretty optimistic, and I think in an environment where returns are continuing to get suppressed at the safer end of the credit spectrum, the asset class more broadly is going to remain something that's very relevant to the large-scale money managers and pension funds out there. So I would be sat in the optimistic camp.
And I think on my side, what we have some grasp of is that in Europe over the next 18 to 24 months, there is a perception of greater volatility, whether it be Brexit now, or as Nigel mentioned, Italian referendum. Then we've got French elections, German elections coming up, Dutch elections. We don't have a government in Spain yet. There's a lot of volatility in the market, and then the question becomes for an LP is given the potential market volatility and political volatility over the coming 2 years, what are the interesting asset classes to put money into? And I think that's what LPs are going to have to grapple with over the next 6 to 12 months. Is it ones that are traditional buyout? Is it special situation? Is it credit? So I think that's where we've gone from a gently growing European economy over the last 2-3 years to one laced with uncertainty over the next couple of years. And so I think how you generate returns is going to be a critical part of the LP decision.
And ultimately, that's helpful because that's, I think, what limited partners pay private equity asset managers for, to make that decision or to help that decision along its way. Thank you. Now, what I'd like to do now in the last 10 minutes or so is to move to questions. They have been rolling in. You've been very enthusiastic. Thank you with the button. I'm actually going to start with one which I think we've almost answered, but let me just read it to you, Nigel and Karim. I'll put it to you, Nigel, I think, to start with. How will Brexit impact access to continental Europe fund managers to the UK, being institutional pension funds, insurance companies, fund of funds, endowments, and so on? Last question from that person: will they be able to fundraise in the UK under the AIFMD regime? I think that touches on the reciprocity aspect that we remarked on earlier. What would be your answer to that question, Nigel?
Yeah, look, it's a great question. I think if you take a step back and think about it commercially and leave the legislation to one side for a second, the UK government, I think, would be nuts to do anything that restricted anyone's access to capital from the UK or access to the UK from the perspective of capital. I think one of the big strengths that the UK has is the size and scale and depth of the capital markets that are based in London, and I think everybody on both sides of the negotiating table is going to be at pains to ensure that depth of liquidity is preserved. I think if you look across Europe, the reality is the economies of every country in Europe need these large-scale, deep, liquid capital markets to finance themselves, both in the debt and equity space. So I think we can feel reasonably comfortable that everybody's going to kind of start off from the basis that there should be a reasonably free degree of access to capital across Europe.
So the two-way street, fundamentally.
Yeah.
Yeah, I would agree with that. Thank you. Moving down the questions, and they're coming in thick and fast now, so I'm not sure we're going to be able to tackle them all, but let me pick some that are particularly interesting. We touched on sectors earlier, from perhaps the difficulties in certain sectors, financial services, construction, and travel. One webinar participant has asked the following. Focus on agribusiness. How will Brexit affect this market environment? That's one that's got me completely blindsided, so I'll punt it to you, Karim. How about that?
Thank you, David. So I think there are a couple of aspects to it. One is we're clearly a net importer of agri products. So the question is, what kind of customs duty environment do we create post-Brexit, which could have an impact on agri imports? I think what will be interesting on agriculture is, given that we were once, or still are, but will have been once part of the Common Agricultural Policy, how does that, us leaving Europe or leaving the EU, how would that impact our trading relationships with non-EU agricultural economies? So as one thinks about agri, there's a potential shift in potential suppliers to the UK, depending on what kind of tariff agreement we come up with. We come to the Europeans. Let's not forget, a lot of our European imports are subsidized imports. So I think it could be, there could be an interesting emerging market play here, depending on the kind of trade agreements the UK can come up with across Europe. The other interesting thing is, now that Europe will have lost one of the biggest net benefactors to the EU budget, what impact does that have on the CAP budget as well, and how does that impact the European agricultural sector? So I think there are a lot of potential outcomes here, driven by the UK no longer being part of the EU. And that can impact both local players in Europe as well as those on the periphery and further away in terms of trading relationships with the UK.
Thanks. You answered it far better than I could ever have done in the time available, Karim. Nigel, any commentary from you on the agribusiness sector?
No, I think Karim's comments covered it. Okay.
Well done, Karim. I think you bailed us out there, both of us. Thank you. There was a question, interestingly, one that came through a few moments ago about the impact of Brexit on sovereign wealth funds. Do we think that the potential Brexit is likely to cause sovereign wealth funds to reorientate their portfolios to, for example, continental Europe or the US? I'll stick with you, Nigel, on that one, if I may.
Yeah, look, I wouldn't have thought of it as a particularly high risk. I think the reality is these sovereign wealth funds are looking to diversify away from their core markets. They come to the investment approach with a very, very long-dated view. And I think you may well see the currency impact that we've all talked about be something that causes them to take the view that it's an interesting time to put cash into the UK on the cheap at the moment. But fundamentally, they've got so much money to manage, all these guys. I think it's difficult to see them viewing the UK on a long-term basis as uninvestable. So I wouldn't have thought it causes a dramatic shift in behaviour.
Karim, would you agree?
Yeah, I agree. I mean, I think, as Nigel said, they are diversifying their portfolio globally. The UK is and will always be an incredibly important part of worldwide GDP. They are also hunting yield and high quality yield, and the UK will always have good high quality yielding assets. And as Nigel said, now with currency, we're seeing pricing has come down 15-20% for them. So it could be an interesting time for them to invest. So I don't see it having necessarily a dramatic impact. What it might do, which it will do, I think, for a lot of people, is question the timing of the investment and making sure they get the timing right and making sure they invest at a time when they know enough of the facts about what's going to happen to be comfortable doing it. But as a investment center for sovereign wealth funds, long term, I don't see Brexit having a massive impact. Maybe in the short term, but not in the long term.
Very good, thank you. I think we've got time for one more question, and they've been coming in thick and fast. So I apologise to those of you who we've not been able to respond to direct. I'm sure the Super Return team will figure out a way of dealing with those questions that remain unanswered. But the last one, I think we've got time to cover. I'll put it to you, Nigel, if I may, and I'll read it verbatim here. To what extent do your expectations for the impact of Brexit on private equity and debt structures in the UK apply to Europe in general? I think that's your box of tricks, Nigel.
Yeah, look, I think there is a meaningful difference in terms of the extent to which PMs making debt investment decisions in a UK business will perceive Brexit risk versus the equivalent business in France or Germany. So I think there is a difference. I think it's clear that the bar will be higher for UK assets. And then as I described, I think there is a technical overlay. I think it's going to be a lot easier for a large amount of the available liquidity to play in euros versus going through the brain ache and hassle of putting a cross-currency swap on to play a sterling-denominated transaction. So I think from a liquidity perspective, Europe's going to be an easier place to raise money than the UK. So I think it translates into a bar is higher rather than a market is shut for sterling, but certainly I think there will be a difference.
That's helpful, thank you. I'm looking at the clock, and I think, as they say, my time is up. I'd just like to conclude really by thanking our webinar panelists, Nigel and Karim, for their contributions. I've certainly found them helpful, and I was certainly bailed out when I got stuck, so I certainly need to thank them. I'd like to thank those of you who contributed questions for doing so. It always makes it better, and I hope we responded to as many of them as was possible in the time frame. And lastly, thank you all for joining us here today at the Super Return webinar. Don't forget that you can keep up with us in conversation via the Super Return Twitter page. You'll see the credentials on the material in front of you. And we look forward to seeing you at future Super Return events, and I certainly look forward to seeing many of you at the next Super Return conference. Thank you all for your participation.